What's up, everyone? Nick D'Angelo with Health, Wealth, and Legacy Show. I'm here today in beautiful Snowbird, Utah. I'm on the top of the mountain. I'm 11,000 feet in elevation. So if I'm out of air at any point, it's because I'm talking fast and I'm at an elevation I'm not used to. I wanted to take a moment today and talk about the 5 biggest considerations when evaluating whether you should invest on your own as an investor or if you should invest in a fund. I get this question all the time, and I love it. It's one of my favorite questions. Not because the answer changes every time, it's pretty much the same thing, but because it shows that people are being educated and they're being interested in real estate more and more. So I'm always rooting for people to be involved. I think it makes the market stronger, it makes it more interesting, and it's more opportunities for everyone. So I've narrowed it down to my top 5 considerations, things that I think that people significantly underestimate or significantly don't have an understanding of while they're making this decision. So the number one first consideration is, how much experience do you have? Very simple, right? I think that there was a misconception at a certain point in the market with a book called Rich Dad, Poor Dad. I love that book. I think it's fantastic. It's gotten many people into real estate, and it's really shifted the mindset between people where they are able to envision and understand an investment process beyond what they were taught in school. So I think it's very, very important for those reasons. However, there's also this interesting thing where it's like the leap before you look, right? And so that's gotten a lot of people in trouble. I think that's something in real estate today that's very common on the lower end of the spectrum, the entry level. And that's something I want you to bring up and to consider today. Investing on your own without the experience is extremely high risk. Extremely high risk. As a matter of fact, I would change the word from investing to speculation. Okay, because speculative investments are things that are not nailed down. They're things that there's a lot of guesswork. There's assumptions that may or may not be rooted in important facts and market data. And that's what we want to stay away from. That's the number one killer of deals. So if you're not a seasoned professional, the question is, are you investing by the numbers? Are you investing in opportunities at that level? Or are you just kind of diving in and hoping you're going to figure it out, which I highly don't recommend. However, if you do have significant experience and you've been around the investment model and you understand the investments, then it might be a good opportunity for you. You might want to consider investing on your own. There is a lot of upside. There is a lot of upside to it. However, there's going to be some other balancing factors, even if you do have experience, which we're going to explain in a minute here. If you don't have the experience, then I really fully recommend considering a fund. There's a little cheat code you can do if you invest in a fund, and that is called learning while you're already investing. Learn at the same time you're investing with the pros. See what they do, see how they do it, and then you can decide, is that for you? Do you want to jump in? Do you want to be involved and handle that, manage that day to day, top to bottom? If yes, then make that decision. But you can start investing with someone else who already has that bearings and has that foundation. Number 2 is, how much time do you have? I think this is the absolute number one most underappreciated and underrated question when talking about investments and real estate in general. There is no such thing as a passive real estate investment. There's absolutely none. There are only 2 types: those that are properly managed and those that are not properly managed. And most people, if they don't understand that concept, are falling in the bad category, the one you don't want to be part of. So when you understand the time commitment that goes into a real asset, something that's scalable, something that takes multiple people and a full team to run, then you really understand the time commitment. If you do have that time, and you are able to allocate that time towards investment, that's when you have a much more fun and bigger question on your hands, which is opportunity cost. Do you want to invest in that property? If the answer is yes, okay, and you go in with eyes wide open, and that's really, really important. The other question, though, on the time side is, what else could you be doing with your time, right? whether you're thinking about family or, coaching t-ball or going to recitals for your kids or catching up with aunts and uncles. That's one option. But the other, if we're getting back to the money side of it, is could you be putting that towards your career? Could you be putting that towards the company you work for to be making more on your top line, more and more and more, so that you also have more and more money to invest? So that's one thing to consider. And there's no right or wrong answer. Only you can know that. So if you do have the time, you do have the experience, and you want to move forward with personal investment, yeah, absolutely. It's a great opportunity, but I would consider the opportunity costs at the same time. The third, very, very, very very important consideration is how much money do you have, right? Because real estate is expensive. Many have argued for many, many years that it's too expensive, that the returns don't make sense for it. I don't agree with that at all. Although I will admit that cap rate compression is, pretty much at an all-time high. There's a lot of balancing factors like inflation and, the search for yield that many investors are going for today. But all that said, that's probably for a different video. But how much money do you have to invest? Most people have entry-level money. And what does that mean? Entry-level money is money that gets you started in an investment. You can buy a house, maybe you pool some funds with some friends and family, you buy a small apartment complex, maybe you buy something in a little dicier part of the neighborhood or part of town that you can get your hands on and you can afford. However, here's the consideration with that. If you buy an entry-level property with entry-level money, that is the most complicated investment from a competition standpoint because there's more people involved. So if you want returns of a certain level, it gets real tough. Your returns get real compressed, aka much smaller. So that's a consideration on the money perspective. If you have more money to do a bigger investment, that's a whole different discussion. So then you're starting to talk about, higher returns with less competition. That's much, much more interesting. Some would call that the blue ocean strategy. Someone, blue skies, whatever you want to call it. But the less competition you have, if you can level up just with the check right, just with a bigger check right, it's a big opportunity in its own right. So that's a huge consideration when thinking about if you want to do it yourself or go with a fund. Funds, if they raise more money, they have more opportunity. They see the market more. They have a bigger check right for those deals that you might not be able to do on your own. So just something to consider. The fourth is how much risk can you afford in your life? How much risk can you afford? Most people misunderstand what risk means in this context. They think, higher risk, higher reward, right? That's absolutely true, but also risk carries risk, right? So you need to think about the downsides. You need to think about the upsides of that. So the reality being, if you tap out completely, can you survive that? Is that something that you have built into the equation 100%? Because not only should you be conservative in your numbers from an assumptions perspective, but also from the unforeseen perspective. I can say firsthand, we've had things come up for performing assets that were absolutely killer, unbelievable assets, things that were doing fantastic, and unforeseen circumstances came up where we ended up basically fighting for our life with that asset. And we had major market moving impacts that we couldn't have done anything about. They kind of sideswiped us, but we had an entire team at Saint, and we had the best professionals in the industry. We had a network that provided those opportunities and friends that were already doing these huge, big, complicated projects. So something to consider very much so is, how much risk can you live with? The flip side is, at the end of the day, there's risks that are across the board, top to bottom, that you don't even understand until you're there. Things like tenant risk. Many people want Class A, triple net, incredible tenants, but those also, when stuff hits the fan like it did during the COVID pandemic, what happened was many of those stopped paying, right? And then as soon as the enforcement of landlords was able to come back into full tow, and landlords were able to say, hey, you guys owe us some back rent, we'll cut you a deal, but listen, you guys got to pay your due. You got to pay what's due. A lot of these companies, these big multinational, some billion-dollar companies, said point blank, it's cheaper for us to pay our legal department than it is to pay our back rent. So there's some deep waters there. There's some really, really difficult waters. If you, something to consider. But, if you feel comfortable with that risk, you understand that the less risk is also the less reward, the higher risk, the higher reward. And you can balance those factors and understand that you might lose a lot of money or you might make a lot of money. Then, and you sit right with that in your stomach, then okay. Just as making sure, I just want to make sure that you're thinking that through because it's very important. The fifth. And this is what separates the pros from the novices on the investing side is straight away, how much money do you want to make? What returns, what yields are your hurdles, right? The yield hurdle is what a lot of sophisticated funds and managers will refer to as what their bare minimum is. They plan this out. They're not going for 1,000% on everything. It would be nice. It would be really nice to hit 1,000%. But everybody kind of realizes in the fund space, it's not realistic a lot of the time. If you understand what your yield hurdles are, you can more accurately define what you're looking for and therefore go for that. So what do you want to make, right? What's important to you to make? How much do you really need on a return for your investment? And then here's where it gets really interesting because if you take what you would do in the market and then you compare that to a fund, which might have access to better inventory, maybe a bigger check write, maybe to assets that the average person can access on their own, cannot access on their own, there's a lot of times those are comparable returns, right? There's other times they're not. There's other times where there's strategies where, you'll see guys doing individual BRRRR strategies with single family houses. The funds will never be able to touch that. It's just not a big enough opportunity for them, right? So there are little niches that you can niche down and do it yourself. But on a big, large, scalable scale, you got to consider that. If you're saying, hey, maybe I'll make a 12 to 15%, there are many funds that will do that. They'll tie you up for 5, 7, 10 years at a time, but they do have those returns that they project. There's other opportunities where, hey, maybe you don't want to be tied up in your own investment, right? Maybe your investment would take 5, 7, 10 years. There's income funds out there all day long. We'll pay 6, 8, 10% sometimes. 10%, 6 to 10% with flexible money. They'll return your money in a number of, a couple months, something like that. So those are flexible investments. They're not the 5, 7, 10-year tie-ups that are very important. So what do I want to leave you with at the end of the day is the number one thing is know thyself. Hopefully these 5 questions are things that you could digest and work through on your own. See if they're a good fit for you. See whether investing on your own is a better fit or investing in a fund or a syndication or another investment model where you invest together is a better fit for you. And I will talk to you guys soon. Hope it was helpful for you. Thanks.